Hugh, welcome back to the latest edition of the Caribbean Beach Club. How are you, my friend?
I'm looking kind of bedraggled. People keep sending me these CBD creams, and I thought my hair was dry, and I thought, I'll rub it into my hair, but I'm thinking maybe that was a bad idea, and maybe we should end this conversation. But I'm
at least you're not bleeding this time.
That's true. And I have to tell you, your reputation is spreading far and wide. I'm meeting fellow members of your audience, and they're approaching me saying, "Oh, say hi to Raoul." And so you're out there. Your footprint has encroached upon my territory. How dare you, in St. Bart's?
Yeah, see, you're the rock star here, not me. So listen, I wanted to reach out to you because you put out a tweet thread of which 90% of the people responded saying, I have no fucking idea what he's talking about. I thought it was really good, and I thought it would be great for you to talk about it and explain a bit about what your thought process, what you're thinking through with regards to the dollar, rates, and other stuff.
Great. So to make that productive, Raoul, because I think we're at our best when it's push and give and take and the rest, because left to my own devices, again, I mean, no one does a better pole dance than I do. I mean, I can wiggle if you wish.
We don't want this work.
So I don't want to just go off and do my flight of fancy. So we can take it in steps. But first and foremost, I have received a few emails since then saying, "Oh my God, dude, like, got to control your emotion. You're getting angry." Someone sent me an email saying, "Hey, I mean, at your age, you still got you've got a good 30 years." I'm like, 30 years? I'm like, really? You're writing me like I'm going to die? I mean, I'm time stamped to expire, and so I think that needs a little bit of explanation. I was all set, using this wonderful facility that you allow me to use to interview a hedge fund manager that I respect, whose name will remain anonymous. His name doesn't really matter. But the thing was, you got to think this is a kid who's probably got a team of 20 managing billions resources, and like you do, like we sit there on our little islands in the ocean. I surf. I have so many things. I'm presently an architect. I'm living in a work site. I have a lot of things, but I can get myself into warrior mode, where I have the audacity to go one-on-one with one of the world's great managers, someone who makes me think, and I don't 100% agree with everything he says, but I'm in a position where I can put myself into a position where I can push back on these people, which is a long way of saying that arguably I'm a sociopath, and arguably a lot of successful people are sociopaths. I mean, I know there's like a list of 7 things, and for sure everyone can read 1 or 2 and go, yeah, I kind of get that. But when you kind of start at the first and you've ticked every single one and you're at the 7th, you're like, oh shit. So I'm a sociopath. Okay.
So what was the bit that made you sociopathic? Was it his view on the dollar? Is it the market's view on the dollar? Is it what is it that triggered the tweet in the first place, aside from being stood up at the altar?
Like I say, it's not really. I don't care if the guy was busy, and good luck to him. He's managing money, and with the elections, it can be 24/7. I've been in that kind of that rage of the trading cloud. The point was that
Sorry for interrupting your video, but I have a very important message to share. At Real Vision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on the Real Vision YouTube channel, that's just the tip of the iceberg. You should come to realvision.com and see how we're not leaving any stone unturned. From publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts, fellow subscribers, and learn from everyone's experience, which can't be wrapped in a video. It's an experience which you live and learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1. I don't think it's something you could afford to be without.
always managing money, and with the elections, it can be 24/7. I've been in that kind of that rage of the trading cloud. The point was that I had, in switching over from surfing to warrior mode, if you will, I got clarity in my mind, and I've been carrying a lot of things for some time now. Probably I've had an inventory of timelessness in my head for 2 months, but hitting warrior stage, suddenly, it was the matrix and I could see it. And so I sat down. Presently, I have no kitchen. I'm juicing, and so I skinned a lime and some ice and some tequila. And I thought, right, okay, we're going to have fun, and it flowed. And I love the cadence which is produced by Twitter. That discipline. I had to take an H out of schmuck. Apologies, but there's only so many characters, and I think you got my drift. So first and foremost, it's that, okay, and then obviously the dollar has been strong this year, and the dollar lately has been weak this year, and like I said in my tweet, it's kind of on its ass just now. And there's somewhere around that, let's say 92 or so on the dollar index. And chart-wise, you think, if we lose there, you're going to be 90, and then you're going to be knocking on kind of 85. And that ends up being really a big move when you consider the normal volatility that supports these trading ranges. And so my question was, is that going to happen? And then that's when kind of all my kind of negative interest rates and the like, and of course, and good old Luke Goldman or whatever, and his theories and the like. And so it all kind of came supercharged in my head, and I tried, I guess, to do a kind of a Jack Kerouac version of it. So I guess the principal point is that the exorbitant privilege which the US is assumed to run, this ability to print money, which of course has been accentuated by what I prefer to call central bank propaganda as opposed to central bank action, which is to say the quantitative easing program of creating essentially surplus banking reserves that the banking community has very little desire to turn into credit risk or loans. But they keep, and indeed Jay Powell, during the height of the crisis, when he was trying to kind of give out a message to, the good, ordinary working folk of America, saying, hey, we got your back, we're doing something. And he was kind of fibbing. He was a bit kind of, liar, pants on fire, because he said, we're printing money.
You can kind of see it from M2, right? The money comes from the Fed, and then it doesn't really go anywhere. It gets stuck in the banks, and Europe's the same. I looked at M2 in all the major countries around the world. Every single one of them, velocity of money, velocity of money is below 1, except the United States, which is at 1.2, which is barely, but every one of them. So any dollar goes in, less comes out. It's unbelievable.
Initially, of course, and by initially, I want to say the sort of April-May rolling data as it came in, and there seemed to be a surge, and there was a surge, but it's this surge of fantastically silly behavior, which is Procter and Gamble can raise like $5-10 billion at nothing, and people are desperate to engage with that kind of lending. It's meaningless, and Procter and Gamble are incentivized to do it because there are very, 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 very dark moments when even they can't access credit. So why not? But again, this lending, which is not going into productive or even unproductive speculation, it's just sitting there in bank vaults. So we had an initial, hey, they're printing money. Hey, the M2 thing looked as if annualized it's running at 25%. But what do we see now? And behind the magician's curtain, I want to say in August, I had the great honor of presenting to a credit union in the northeast of the United States to the directors. Like I say, I tap dance. But what I didn't know was that as part of the emergency COVID, not precautions, but kind of like state of play, was that banks are not allowed to repossess, and banks are not allowed to share credit records or credit history from their peer group. So, which is quite remarkable. So you have bankers who are fearful of the credit risk that exists in the economy. Why are they fearful? They're fearful because largely for the last 10 years, we've been in a form of depression that doesn't dare reveal itself, but it's there. I want to say for ordinary households, the last 10 years kind of probably wouldn't be that different from the period 1934 to 1937, 38. If we ignore John Steinbeck novels of the
Dust Bowl.
The Dust Bowl, the profound, not only the economic, but, weather patterns and over farming and the lack of understanding about nitrogen fertilizer, the complete tragedy. And that's the kind of brown, grainy images we have of the Great Depression. But 34 to 38, kind of people got on with it was drudgery, if you will. And that's how I have described the last 10 years. So it's a depression which no one talks about. And that's what's making risk takers fearful of risk. It's why we're getting this bifurcation in credit markets, in that if you have very little credit risk, then you are apportioned an astonishingly rich valuation. There's literally no upper bound to the price that people are willing to pay for safe custody during a depression. And of course, its antithesis is if you're an airline stock, a retailer, a whatever, then you might find that your share price is trading at where it was in 1982. This is a market of two extremes, okay? So in that environment, can you imagine you then take the bank who say, I'm going to blindfold you, okay? I'm not going to give you any credit information. Now, and I'm going to give you lots of reserves. Go and lend money. It's never going to happen.
No, and, it's a structural problem also because the banks in Europe don't lend anymore. And they don't really use the bond market as much. The US has stopped lending money. You look at the loan officers survey, they've stopped lending money. And that's pretty much happening all around the world. So as you say, it is a bit of a magician's trick that they're claiming that the printing is helping everybody out. It's not. You look at the numbers, it's basically sitting on the bank's balance sheets.
That's it. But we have this propaganda that they're printing and it's inflaming people. And so back to this notion of this exorbitant privilege. Hey, and Luke gets really kind of, hey, and he's out there. Hey, the dollars. We even had a piece, Brent Johnson forwarded the Ken Rogoff piece. Hey, dollars due to take another leg down. And I was like, really? Because they're printing all this money. Again, really? And so actually, I started looking at trying to deconstruct it. And I find that the privilege has been handed over to the other side, to the mercantilist nations of essentially Europe, of Southeast Asia. Okay, and they will not permit the dollar to devalue. Okay, because if we were to go to 140, the Eurodollar rate was to go to 140. Where is the European economy going in that? Where is your GDP assumption, right?
Bleak. Yeah, it blows up. Yeah.
Bleak. Okay. So, and the trail path is being set by the Swiss central bank. And hey, if I was them, I would do exactly the same thing. They actually do print the fiat currency, and with the fiat currency, they buy dollar assets, be it shares in Amazon, be it gold, or be it treasuries. They're all the same. They're denominated in dollars. Okay, and therefore, it's the willingness, it's the ability, it's the mandate of all of those global central banks to react individually, but collectively, to print their fiat, to sell their fiat, to buy dollar, which I believe is denying the US the opportunity to have a devaluation.
Because of all the other central banks' action. So everybody is basically mercantilist. They're all trying to sell more of their own currency. And the net result is they're always buying dollars in one way, shape, or form. So whatever the US tries to do to lower its currency, because everyone talks about the rate differentials or growth or whatever, it doesn't seem to work. I mean, I've noticed this for a long time. The dollar still either stays here, chops around, or goes up, but it doesn't go down.
Exactly. It's a dirty time series which doesn't do a lot. And that's most likely to continue. So, but if I was the US, I'd be like,
Before we go into this, why should the US want to lower their currency? I think that's a key thing people need to understand, and then we can go into the mechanisms.
And of course, the antithesis of that question is, why does the rest of the world want to be mercantilist? Okay, so, and it's just a model. The rest of the world feels, and perhaps, and for sure, in some parts of the world, there is still a comparative advantage, and for sure, there's a comparative advantage with the renminbi closer to 7 than say 5. Yeah, for those countries to produce things.
One of the things I looked at, Hugh, is I wrote a piece in GMI over the weekend. Is this mercantilist kind of activity around not debasing, but kind of lowering your currency came out of the WTO agreement in '96. Because when you equalize tariffs, how do you compete? Price.
Yes. Yeah. No, absolutely. And I remember, how long have we had the fix on the Hong Kong dollar peg? It's a long, long time. It's a long, long time. So they want to produce things. The US, up until Trump, and we'll see the direction. But given the representation of the Republican Party in the elections, you have to think something remains in the sense of the kind of make America better by kind of trying to have less hollowing out, less of the fight against mercantilism.
Yeah.
But it's kind of like, so just now, I would say that we've actually pushed too far in favoring the mercantilist. And it was kind of okay because the US still had a balance sheet that it could tap in terms of it could leverage further. Since Richard Branson bought Necker Island, let's take it to the source. Richard Branson of Virgin fame nailed the bottom of the debt cycle, which had begun with the bankruptcy of the US banking sector in the early 1930s. And with that unnecessary bankruptcy, but we had central banks who were ideological zealots back then, and as a result, we had a bankruptcy of the banking system. And the message from on high, and from all of us in society was, you got to get your act together. You got to stop taking these stupid risks, and you got to deleverage. Okay. And the US economy went from, let's say, 3 times debt to GDP. And when Tricky Dicky was buying Necker Island, we were roughly about 1.3 times. So it had taken 40 years, and we had deleveraged to the tune of 2 times GDP in terms of the outstanding debt quantity. And in that environment, a Scottish laird wants to sell his island for $1 million, and Richard says, 100,000 maybe, and they shake on 150. That's the opportunities that do not present themselves to us today. That was 40 years ago. Okay. So the problem with the mercantilist model today, and the problem for the US's willingness to accept it, is that at 4.5 times debt to GDP, there ain't a lot of desire to take on more. So there's one thing, hey, we take your jobs, but we put an extra 0 on your credit card balance. It's okay. That kind of thing, the climax of that was 2006, okay? And of course, the savage housing market decline then rolled us into this nameless depression that I'm talking about. So that takes us where we are today. It's stalemate. Nothing's happening because they're still pursuing mercantilism. They're still kind of pushing dollars, like they're pushing their savings to the US and saying, have fun, a bit like the Fed. The mercantilists like the Fed. The Fed's turning to the banks and saying, this one's on us, guys. Like, here's 7 trillion. I'm looking that way. I'm your regulator. Normally I'm on your ass, but I'm looking that way. Here's 7, have fun, have a party. The parents are out of the building. And the kids are like, no, I'm doing my homework. And it's the same with the mercantilists. Hey, look, we're looking the other way. We're buying treasuries. They're egregiously overvalued, but we don't care. Have the money. Just buy something. Buy anything. We don't care. But that's not happening. So that's the inertia. And that's the failure to escape, to get that velocity to escape the inertia that we found ourselves in for the best part of 12 years.
So why does the US want the weaker currency now? Why should it start thinking, you know what, if we can lower the value of the dollar, it's going to solve us problems? Is it because the US needs to export its way out? or does what is it?
Yeah, thank you. You've teed me up, and I found coherency from the CBD oil rolling through my hair. In a typical adult lifetime, you might experience 3 or 4 recessions. Yeah, but you could spend all of your duration on planet Earth and have the good fortune of missing a depression, which is to say thankfully, they're very rare occurring events. And I kind of tried to hit upon this in my thread, that the first business cycle depressions prior to, let's call it 1830, a bit early, 1825 or so, but prior to that had been a function of famine, crop failure, and the idiots, the sovereign leadership, the kings and their petty wars and wanton destruction of mankind. Okay, that's and as the ordinary guy, you kind of periodically you took one, In the 1830s, you're like, you've lost your job, your neighbor's lost your job. If you got a job, you've had to take a huge haircut, like you don't have enough. The kids are begging on the street, and you're like, okay, we didn't invade France or Spain. The last time I looked, the crops were fine. What gives? Okay. And what had given was that after in financing the UK's victory over Napoleon and the like, we had come off the gold standard. And the London central banks really, the kids had a party. They kind of went, whoa, hey, there's this big place called America. And they started funding transport bonds, canal bonds. And they discovered shady characters in South America. And sovereigns never go bankrupt until they do. And the UK did come back onto the gold standard. And of course, there was a cycle of exuberance which led to its inverse. And so London banks were pulling in credit, and they were the center, and they were pulling it in from all corners of the globe and creating this new strange thing called a deep business cycle of depression. Okay. Now, and it was nasty. It's why we get Les Miserables, and it impacted on culture. It's where we get Engels and Marx saying, "Oh, it's now time to redistribute, off with their heads." That didn't come to pass, partly owing again to the constant of human ingenuity. But I want to say it was terminated by finding a looseness in policy, which was sufficient in degree to kind of push people back to change. Remember, I'm all about psychology, to change the psychology from fear and just get some curious minds going, ooh, those canal bonds look kind of cheap. What was the monetary innovation? Monetary innovation was the discovery of the substantial Californian goldfields. And at the time we were on a dual. Where are we on a dual standard? I'm not sure, but we kind of moved back and forward between silver and gold, and so gold becoming more plentiful allowed banks to extend credit. And like I say, people are like, wow, yeah, no, this conditions are now they're sufficiently loose. I kind of want to have a go, and I'll keep it short. The second time around was characterized by William Jennings Bryan and his run for the United States presidency. He ran twice. In the 1890s, he ran against the backdrop of the second failure. Again, London banks lending too much money, and this time it was very much to railroad bonds, and again, very much to shady South American governments. And that kind of, we had 20 years, and that's the Wizard of Oz. That's the kind of the Wicked Witch of the East, is these banks that keeps calling in the money, and it's the poor factories which are shuttering and closing. And that's what William Jennings was standing. His platform was, we're being crucified on a cross of gold, and the yellow brick road, and Dorothy, she wore in the book, she wore silver slippers. And I was like, hey, let's bring silver's really plentiful. Let's ditch gold and let's go back to silver, and let's have that monetary response. Remarkably, he was ignored. But that depression came to an end because a Scotsman, who cares, he could have been Russian, he could have been whatever, but a Scottish engineer just had the breakthrough in terms of leaching with cyanide to extract gold from the South African deposits. Yeah. And again, that was the most gigantic expansion in money supply. And we were back and off to the races. So I want to say to you that we have had few depressions, thankfully. And their remedy has been a kind of out of the blue monetary, who would have thought that? Who would have thought that? Discovery. Now, I'm not suggesting we're going to discover gold on Mars or Moon or whatever. I think it's more mundane than that. I think, actually, that the reserve currency imposing like a 300 basis point negative charge on these surplus redundant savings in its economy would be the equivalent of creating Klondike fever. I think that's the thing that could unlock this. Okay, and so we don't need the dollar to be weak, and it's not an option which is feasible or available. Okay, but there is one knocking on the door, so to speak, which is innovation in the Fed's response to depressions.
And so the innovation, and it seems to me the Occam's razor, because it's pretty bloody straightforward, you just go massively negative. And what happens is the dollar weakens, the banks turf out all of the money that's sitting in their vaults saying, hey, we don't want this stuff, let's give it to people. And people who are holding dollars say, we don't really want to hold this any longer because it's a bit costly, I'll do something else with it. Is that the kind of idea here? And money gets flooded back into the system and not hoarded?
It is. But I would maintain that the dollar doesn't weaken. Again, the dollar, it can't. There's no limit. What's after $1 trillion? Who cares? But there's no limit to the Swiss banks. I did a thing on Instagram, and I had a picture of it. Again, the murky brown, grainy image of the desperately unfortunate German citizen with a wheelbarrow of banknotes going to buy food. Yeah, going to buy a loaf of bread. And my point is, like, I'm going to show you something shocking. This thing here, this thing is an iPhone. Okay, think of the number of. I'm sure someone will correct me that there is a limit to zeros that in terms of currency that I could put on this phone, right? And I would just with the terminal go, bing, okay, bing, bing. So there's no limit to the monetary digital printing press response to the US move towards 300 minus basis points. Okay, and again, 300 minus basis points. The models. I'm not a great believer in models, but the old looking at inflation, looking at the output gap, kind of saying where the interest rate should be, kind of does typically come round about those levels. And if you went that way and you had minus 300 at the short end and you were minus 100 at the long, at 10 years out or 7 years average maturity, it kind of would all start making a little bit of sense, So really my point is more, again, that I still believe that central banks have been shorn of ideology. Now, in its replace, they have yet to find wisdom. On the other hand, people like us, our competitors, are the ideologues, and pretty much the roles of swaps, and pretty much most of the people watching this will be thumb downing me because they want to be me in 2009, 2010, 2011, 2012. I was a miserable curmudgeon. I had the foresight to see the crisis. I could see the idiotic behavior of my peer group. And I wanted to purge the system. I wanted to put them in prison. I wanted to give them lifetime bans. I wanted to eliminate them. And the Fed thankfully said, hey, Hugh, look, take more CBD oil, calm, okay? And they said, because that road, this people say, well, you solve this by putting interest rates up. No, you don't.
No, you don't. Never believe that argument. People say, well, the Fed have abnormally lowered the rate. I don't think they actually have. There's a regression against demographics, and it's basically where it should be. Now, the interesting question is because I say I think the Fed goes negative, and I think the markets take them there first. But you're pushing that discussion even a bit further, saying not only negative, but historically massively negative in a way that is disruptive to everybody's ideology.
Yeah. And that's kind of, again, one of my tweets, God, I wish I'm quoting myself, which is unforgivable. And I've got a terrible memory, but I was kind of saying that I feel like myself as a macro mind, I've spent this century a bit like the USSR did the last century, like in denial, like our rules just don't work.
So basic, and maybe it's just a false set of rules that we all cling to. These aren't rules. The zero lower bound. Well, guess what? The fucking Bank of England went negative. Well, they're about to go negative, but UK interest rates have been negative now. First time in 500 years. This could never happen, but it does.
It does.
And therefore our rule book is wrong.
Yeah. And then again, let's kind of take it from theoretical, fanciful flights of fancy to the grim reality of today. And again, where we create imagined realities, which I don't think really accord with action on the ground. So interest rates are really low. And like you said, the Fed's at zero, and we've got some central banks which are actually negative. Funny thing is, when I go to borrow, okay, and I borrow in euros, so at first blush, this is going to sound fantastic. And I went, whoa, I got to borrow fixed at 2% for 20 years. And I go, wow. But dig further, and it's like, well, the 2%, they were screwing me because with market rates, it should have been, and risk added on, maybe I should have paid between 100 and 200, 120 basis points, not 200. There was 80 of kind of, thank you very much, drop the soap. But worse than that is the need to amortize the loan. So 20 years, effectively, I'm repaying 5% of this debt outstanding each year, which to say that my cash flow is minus 7%, 2 plus the 5. I've got to find 7%. So I borrowed 5 million. Right? I've got to find 7% of 5 million, and I'm presently doing up like rebuilding a house. I want to do 2 or 3 at the same time. I can't. No. And again, where this is ridiculous, and I'm kind of having my cake and eating it, but because and by that I mean I believe that 10-year treasuries are somewhere between a range of 65 basis points and 85 basis points because the US private sector banking community is not taking the $7 trillion and lending it, not taking the quantitative easing money and lending it. I think that explains why we're at market rates. Others disagree and say the Fed is buying. Okay, so let's take that argument. If the Fed's actions are actually, it's like Atlas, and the Fed's like, don't worry, I got your back. I'm going to hold these collateral values. In fact, I think I can push them higher. Yeah, they're going higher. So the Fed's got your back, okay? What's the point of insisting that you have to repay? Give bullet loans. In 20 years' time, I know that my property in St. Bart's with the Fed, like Atlas, right? My property value is going to be like 1.5x minimum what it is today. So just allow me to pay the interest component, okay? Because the Fed is doing a good, if you will, the central banks around the world are supporting the asset value. So rather than just an asset value which makes rich people feel richer, but they don't go out and consume it, give it to people. And okay, I'm not necessarily representative, but I would spend it. Give it to people, make that holding or supporting or pushing, elevating higher asset values, make it click into real decisions, which would allow me to employ more plumbers, more electricians, more carpenters, more lawyers, more accountants, etc.
My argument with that is all well and good. Without something like a central bank digital currency that allows us to direct it in certain ways, it just goes into the stock market, which is not doing anybody anything. If you said, here, Hugh, you can have a loan for 1% interest, bullet payment, 20 years, has to go into property, and you have to invest in the building of it. Okay, fair enough. That's a good bet if you want to take that bet. But right now it doesn't happen. So if the Fed were to go to negative 2%, just a bunch of rich people buy equities and get richer. How does it become a better mechanism then? Which is why I'm very interested in the digital currency route, because you can change policy on different people.
Yeah, I mean, I'm still a little bit suspicious on digital. It just sounds trendy. I mean, you can just put a mandate to loan officers across the United States.
Have done this. You know, you and Richard Werner talked about this, right?
Yeah, you lose your license if you don't play, then lose your license. So it can be, but that's semantics. Digital or central banking kind of being kind of tough and mandating this. And again, that takes you to Richard's point that then you can actually try and direct it to the least offensive, the most reward. I still think there are rewarding investments that you can make today in the global economy. I think it's just been written off by a general kind of nihilism or the like. But the key to this and the key to the negative rates, which we haven't discussed, is you need profitable banks. Okay, so that's why I was saying in my paper that the Federal Reserve, we talk about yield curves and inversions and the like. First and foremost, the central bank is the banking regulator of domestic banks in the United States. And as a regulator, it should say, we're doing this and it's being passed on immediately. And you know what, we give you, I think you get deposit insurance up to about at least $100,000. So we're kind of going to charge for that now. Like if you actually have, I don't know if it's 100,000 or 250,000, there's a figure out there whereby you can say, hey folks, if you're kind of sufficiently comfortable, if you're the type that got 250,000 spare dollars sitting in your bank account, earning kind of zero, you know what? We're going to charge you 3%, okay? And then the banks are going to bring down their lending rates, but they're going to get, I want them to get a higher, fatter margin. And the profitability of the banks is going to be taken and it's going to be paid for by the creditor community. There's two parts of the economy.
And you can still have a 250 basis point steep curve as well.
Exactly. So you can still, because you need profitability, because the key to this is fostering a change in psychology. I want banks to be greedy, not fearful. In terms of society hates banks, okay? So banks were happy, cheerful people who gave you loans between 2000 and 2006, regardless if you committed adultery, if you had been in prison, if you had been a serial bankrupter. They're like, just take the money, all right? And we still castigated banks. Normally we castigate them because they don't give us the money. So we don't like banks. Let's just deal with that. The system works when banks are profitable.
So let's assume that we're now in this new, I want to live in this world a little bit. So we're going to live in this negative 300 basis point world. Right, so I'm Societe Generale. I say, Hugh Hendry, I'm going to lend you $5 million at 10 basis points. I've got a 300 basis point margin on that because I'm getting it from the central bank at negative 300. You're paying no interest and a bullet payment, right? So that's like the opportunity of a lifetime. What happens to the pension funds and everybody else who needs cash? What do they do in this situation?
Well, pension funds. I've got to be careful because I was going to launch into a tirade there. Because what I want to kind of put out there is that we've had a cycle, a 50-year cycle, again, kind of related to that deleveraging and then re-leveraging.
Yeah.
And it's a cycle which favors kind of. The last cycle has favored creditors over debtors. So it's favored, if you will, Saudi Arabia, right? An act of randomness that on its territory, it had these oil reserves. And it has no ingenuity, no cultural ability to transform that into ways of changing the world on their own, which is fine. We'll give them a pass for that. But they go into the genius of our market economy and say, hey, we're creditors. We've got a ton of money, but few ideas about what to do with it. And we then engage them with people who've got like the Steve Jobs of this world, the square pegs and the round. I'm going to change the world. I need. Bingo. Okay. Now we've had an egregious over distribution to the South, not to personalize Saudi Arabia, but to the Saudi Arabias, to the creditor, and particularly the creditor sovereign nations of the world. Which is to say that when we came in and we did this rent transfer, or the imposition of a tariff to access that credit, we were overpaying. Which is to say you've been overcompensated for being a creditor for the last 40, 50 years, which is why assets are this price, okay?
In the old model, capital made all the money here, right? Anybody with money made money. Anybody who needed money didn't.
And that's why today that's why we had Brexit. That's why we had Trump. That's why Trump is still about to be booted out. But, he got 70 million Americans to vote for it because of that power. Okay. And so as we live in this imagined reality of what might come to pass, we're trying to find now this 70 million people that feel disenfranchised by the last 40, 50 years. And we're trying to say, hey, listen, I can make a difference because we sat China and the ilk saddled you with debts. Amazon persuaded. Have you seen when I look in the cupboards and I see the junk that I buy from Amazon? I mean, what gets into my head? But we've persuaded you to take on this debt, to buy this junk, okay? And now you've just got to keep paying it to the man. We're from the government, and really, actually, this time we're here to help. Those monthly payments, they're going to go to zero. Right? This one's on us. This one's for you. So what we're trying to do, because remember, whilst the 10-year rate is at 75, 80 basis points, right? Whilst Japan's got negative 20 basis points, etc. In the real world that we live in, credit is hard to get.
Credit card rates, all-time record highs. They're above where they were in 1990, when interest rates were at 6 or 7%. So, yes, credit is it's a bifurcated market. The haves can borrow all the money they want. As you said, Procter & Gamble, any size at any price, negative interest rates. Somebody else, the high street shop that's closing down right now, zero chance.
So there you go. So what I'm suggesting to you is that we give everyone the Procter & Gamble edge.
And I get that. But what I can't see through in this theoretical world of the future is, what do Procter & Gamble do? Or what happens to leverage in terms of GDP? We'll talk about some other impacts in a bit, but what happens to leverage with the unnecessary players taking even more leverage?
That may call upon your insight with the digital, and that may call upon the wisdom of the princes of the Yam with Richard Werner to say there is a market-based pricing, market-based coming together of creditor and debtor agents. It's a wonderful system. It's rewarded us, but we can still improve it.
Why did these PPP loans or whatever they were, why did that not work? Because wasn't that this, really? And I don't know the ins and out mechanism, and neither of us live in the US, but the reality was they said, small to medium size enterprises, here's as much money as you need. And
no, the problem was that the Fed's mandate from the 1936 Fed Act or whatever doesn't allow those debts to be written off. So you can walk away. The Fed would be on your case until you went to your grave. It was a perpetual liability that you couldn't absolve via the usual kind of bankrupt. I think someone can correct me on that, but that's what it was the hardest loan to renege on.
So as part of your theoretical new world, you need somebody to not ask for their money back at the end. What happens with a bullet payment?
Yeah. But no one wants the money. You only want the money back at the end because there's to make up for the shortfall in the perceived or the anticipated rise or stabilization of the asset value. Now, if the central bank's there, Atlas holding the damn thing high, no one wants the money back.
So then the theoretical other discussion in all of this that I'm kind of interested in as well is, why not just do a $10 trillion perpetual note? A perpetual bond at 2%, inflate the whole thing out, do $10 trillion or 20 trillion, whatever the ridiculous number is, and maybe all the countries around the world do it at the same time. Isn't that also down the same route? I understand it's not directly for the person. Yeah, but that's another way of looking at it.
Oh, I mean, just take the U.S. fiscal program from March, April of this year. I mean, did it really make a difference? Did it really move the dial? What if that money instead? Well, how much was that? Was it $3 trillion? Yeah, and maybe 300 billion of it was a check to people in the post. So 10%, really, that's all. But what if they've taken the 3 trillion or 10 trillion, to use your figures, and just said, you know what, this is a buffer. Like, we've got, like, to the banking sector, we know you're scared. We get it. You're legitimately scared because we haven't had your back and we've let this thing drift too long. We've been stuck, like, it was only like 2-3 years ago the Fed was raising rates, like, and they've now apologized for that. And the next line is to say, hey, stop apologizing and do something about it, okay? And you say, here's this additional equity. Your equity today, you've got to eat through $3 or $10 trillion, right, before you hit your equity. Again, go and multiply.
What you're doing is giving free collateral to the market and then say borrow against this.
But it would have to be prescribed with some kind of mandate against egregious land speculation. I think at that point you would really have to insist back to the model of to fund the construction of a new house, but to buy an existing and then just to feed higher and higher asset price in terms of people passing houses between themselves seems a bad. I think we can work out a form of regulation that would prevent that. I know. I'm glad to say I keep that company.
Because, I don't think there are any right answers. There's ones that are less wrong. And I think people live on this ideology that there is a correct answer that the central bank should do. But if you and I to sit down at the Federal Reserve, if they invite us to say, right, well, you guys are going to run this for a few weeks, and you've talked about this, I mean, we'd look at ourselves and go, well, I don't know what to do. It seems a mess. I can raise interest rates, the world crumbles, cut interest rates to zero, to negative. I don't know, maybe it blows up the pension system. I'm going to give money directly, maybe it creates inflation. I mean, there's not many good outcomes in this. So it's trying to find pragmatic answers that aren't driven by ideology, I think.
But then that's why you get the logjam, because you use the word pragmatic. There's nothing pragmatic, So what we forget, because the distance of time has dulled our memory banks. Paul Volcker was a crazy mother. I mean, we forget with the distance of time. This guy, it's literally like a cowboy movie, and this sheriff walks in, kicking. The bar door, the salon, the two doors swing open, and is like, "Hey guys, there's going to be change around here," and they're like, who's the dude in the Texan? And he's like, and they all turn around and they drink more tequila. He's like, no, you ain't hear me. You ain't hear me. And boom, so what is boom? Like the recessions, your grandfather's recessions, the 1970s, your kind of movement in nominal GDP from peak to trough was big. I mean, we really got big nominal GDP contractions, And of course, Volcker came in after the big one, the one with the initial oil price shock. But he came in on the cusp of the second. So we knew the first one was diabolically bad. We were coasting and like the wave was coming down, and we knew what that was going to bring. And this guy's like, I'm going to raise rates, 100 basis points. Anyone want to play? And he does it. He does it on a Saturday. Who does it on a Saturday? On a Saturday. Can't wait until the market opens. He was insane, right? And why was he doing it? Because the banks had become awash with Saudi Arabia. I keep mentioning Saudi Arabia. They'll probably be diced to pieces in the embassy and saying, well, the oil money, the surplus creditor flow of money, which effectively created the Eurodollar market. We haven't even discussed Eurodollar is like this invisible offshore dollar banking system, which is like arguably 2 to 3 times even bigger than US banks, and we just pretend it doesn't exist. It's this dark web. Anyway, all of that money is like, hey, well, we're flush, and we're making loans to Paraguay, and we're making loans to Argentina, but we're making loans to mom and pop shops or whatever, businesses and enterprise. The one thing we're not doing, banks are a hedge fund. Banks are the most simple hedge fund conceived ever. They only have one decision. Do you lend to the government or do you lend to you and I? Yeah. And back when Volcker came in, it's like, well, we're lending to the public, because it's inflation protected. And Volcker's like, you're making a big mistake. And so he raised rates several times and just made the recession even more ferocious because he had to change psychology from greed to fear. It's like, I'll give you a recession. You're going to buy government bonds yielding 12%. So we forget all of that. So when you said, why aren't they doing pragmatic, practical things? We're talking the opposite. We want them to be crazy, do crazy stuff.
Well, I'm not sure. Well, pragmatic to me means independent of ideology. And I think that's what Volcker did, right? He just said, I've got this problem, and this is the way I'm going to solve it. And what you're saying, I think, is the same thing, but the opposite way around, which is, well, if Volcker went to 18%, we go to -5 or -3. And is that going to change the dynamics of the economy and get us out of this long-standing depression?
And it did, so radical, courageous, radical in the context of it's not been done before. Like, we've not had a Fed kind of push to those kind of limits. But it was necessary because we had to change the behavior of very important economic participants.
I think it changes the behavior of the foreign creditors who put their money in the US, right? All of these, the mercantilists, I think it would change them. I think if you, as you said, regulate it in some way to make sure it goes into the hands of certain people, it does that. The only problem is, and this is where the argument will be in the comments section below, is anybody who's a saver will say, fuck you, Hugh.
I'm the best thing. I'm the biggest Christmas turkey you're ever going to get for Christmas. All right?
Why? If you're my mum, who's 78 years old, and Hugh Hendry decides in all his majesty to wave his wand, cut her interest rates to, they're at 0 now. She lives in Spain. And you're going to say, no, Mrs. Powell, I'm going to take 5% off you every year. She's not going to be happy. And there's still quite a lot of voters. How do you avoid that?
I'm like, you know what? I don't care. First of all,
right, I'm going to get my mum on the phone. You can speak to her.
Go and buy Philip Morris shares. All right, go and buy shares in the bank. Okay, look, so the bank's now screwing you. They're not screwing your mother. That all just gets too visceral and whatever. But this oil stuff's really, really good. You've got stocks, like, make the high dividend yielding stocks safe. That's what you're doing, okay? You don't have to have it's only convention that you have your money in the bank. It's and more than that, it's inertia.
So how do I call my mum up? Because the Spanish banks did this, oddly enough, in 2012. They went, well, instead of these savings accounts, we've converted them for you into preference shares. And then they said,
very much.
Oh, by the way, we can't pay the preference shares. Everybody took a massive haircut, and the Spanish banks kind of laughed their way.
Well, exactly. They got away with it. So the history of banking is consistent and profoundly bad behavior. Okay, they get away with it because we are too preoccupied doing interesting things with our life to phone the bank. You might send one email, but then it's like another email. It doesn't. I've got one friend who just goes straight to the chief executive of giant companies, but everyone else just takes it.
And I guess there is a life raft, whether it's gold or Bitcoin or whatever you choose, there are life rafts. So if you've got cash and you don't want to participate in the borrowing economy. So is this, I guess this is the thing that's going to be on everybody's minds. They're going to be screaming at the screen saying, but this is going to be the big inflation. And you're probably saying, yeah, and that's the point. You get rid of all the debt.
The number one purpose of quantitative easing was higher interest rates to deal with higher inflation. We'll know policies are working when rates go up because we've got inflation. And then we can deal with it, if you will. I throw that out. So people have just got to remember that what we're trying to do, we're scuttlebutting or something. We're taking hot potatoes and trying to, rather than just this ideology that says no. It's like, that's a boring conversation. Let's consider it more. Yeah, like grandmothers and stuff. We sent young men to their death. We still do with international conflict. This is real. But
the baby boomers have never taken it on the chin. They've had it all on a silver platter and screwed it for everybody else.
That's why I really
don't care.
Really don't care. I really don't care. As long as I'm looking after, I'm afraid, I say it again, somewhere between $100,000 and $250,000 of surplus cash reserves just sitting idly in some boring bank account. You're getting no sympathy or help from me. Suck it.
Think about it. What's going on right now is these baby boomers with their cash surpluses are supporting their millennial kids. What you're actually going to do is reverse the equation, because the millennial kids will be able to borrow all the money.
No.
They'll have a future that doesn't exist for the others, and they'll just have to help their parents with their 5% loss on their capital, which is doable.
But it requires courage.
And it might weaken the dollar.
For sure, it would weaken the dollar in terms of depending on time frames. But any weakness in the dollar would, I would set my watch and I would, calibrate the central banking printing of money, foreign exchange intervention.
And should all of the central banks do this at the same time?
No, no, it doesn't work that way. Actually, this is the divine right of the currency at the center of the system. This is why it hasn't worked. And first of all, they haven't really done it within, if you go minus 20 basis points, you're a buffoon. You're just boring me. Yeah, I'm not interested. Like, yeah, you want me to be, wow, ooh, 20 basis points, go, you're a wizard. Okay. But no, it's the preserve of the reserve currency of the world. The US is the reserve currency of the world because of the $25 trillion liquidity of the US Treasury debt market, and on top of that, the unlimited liability, the unlimited liquidity provided for by the central bank itself. So there is no liquidity risk in owning US Treasuries, and arguably, there is credit risk, but arguably there's no credit risk, and certainly less credit risk vis-a-vis other nations. So the preserve of going negative, the US should rather than, like we discussed with WTO, rather than kind of going down the foolish road of imposing trade sanctions or putting grit and sand in the way of trade. Trade's good, but you just got to say, hey, there's a price for everything. You got to pay us 3% to hold these treasuries. We're giving you everything else. We're giving you liquidity. You've got no credit risk. We're giving you our customer, our consumer. But it's going to cost you 3%, and the next 50 years belongs to us. We're probably going to get fat and complacent on it, and let's do a time-dated stamp in 40 years' time, and we'll switch it around, and we'll be paying you 10, and you'll be making all the money. And
what asset do you want to own in this environment? In that environment, where's the optionality? I understand Eurodollar 100 strike calls, right? That's a great trade. Because, and just to explain to people, Eurodollar, I'm talking about the interest rate futures, and the 100 strike is 0% rates. Because, they cost a couple of ticks out till December 2022, let's say.
Yep.
And you could make 100 times your money if it goes to negative 200 basis points.
Sure.
So that's a trade, right? Bond yields fall a lot. Okay, there's a trade. What else would people do? I presume it's gold. And borrow as much money as you can.
Yeah, I want to say it's the status quo until. So if that policy. So to answer that question, you have to make an assumption. Does that policy succeed? And what is success? I think I suggested that success is the need to raise interest rates because the economy is like really profoundly strong and prices really are credibly taking off. That is success. So, but until we pivot and we actually see evidence of that, the trade is still the prevailing trade, which is precious, complex, Bitcoin. People always ask me about Bitcoin. I think I'm going to buy Bitcoin futures. I just cannot.
Hugh,
I just can't deal with you cranks and your digital safes and guys in Japan stealing my money. I always forget my password. But a future, hey, if it's good enough for Paul Tudor Jones, it's good enough for Hugh Hendry.
And you saw
it's the size.
You saw Stan Druckenmiller owns them as well. So
futures, yeah. And it's the size. Everything now is denominated in Isaac Newton apples. Apple is the first $1 trillion company. The treasury market is 25 apples. The gold market is 10 apples. And the thing about Bitcoin is, what is it? It's just a slice. It's a quarter of an apple. And that's That's interesting. That's interesting. But to that point, so Bitcoin futures, gold, silver, treasuries, Eurodollars, stocks which are deemed to be riskless security. You see, again, the magic from this thing is would you believe I do keep the company of entrepreneurs. People can't, the great thing about St. Bart's is it's a network for really rich, successful folk. Some of them are obnoxious, some of them are just amazing, wonderful. And I've got people with businesses, commercial enterprises, which will be flat or up on the this calendar year. They're paying 8%, typically to some hedge fund, because the bank won't lend to them. And the hedge fund's like, wow, yeah, for 8%, maybe, that's idiotic. Okay, in my world, my buddies, I know they're coming to St. Bart's, but my buddies are going to get that money at 50 basis points or something, okay? And they're going to just take out all of the shitty competition and take over the world and make it an even better place. That's the world that I aspire to living in.
Well, let's see how this plays out. I don't know if you're going to get your world, but I still think we're going to get a negative interest rate world. But I do agree that to think our way out of this, because of the scarring that it's done to so many people and the issues, as you pointed out, somebody's going to have to make a big change somewhere. And I'm not sure, people are thinking MMT, is that a big enough change? Feels still a bit marginal, unless you come to me with a $10 trillion number. I don't think it makes a difference. But, it has to be big. As you said, big and brave.
Yeah. MMT has yet to understand the psychology that you have to change. It's not adding zeros. It's actually the manner in which you add the zeros. It's the front, it's the audacity of what you're trying to do. You're trying to you're trying to bring the patient back to life. They're sitting, the people that we trust to take responsible risk in our communities don't want to do it. And that's the number one problem. And so we got to kind of boom, resuscitate them.
So here's a theoretical question. Sorry, I just thought about that. Is MMT not basically the fiscal version of Hugh Hendry's monetary plan? If you go big enough, you're directing it in certain places. You say the money goes to you, and you, which is what you're saying with the monetary. You say I'm going to inject 10 trillion in via the Federal Reserve, via these negative interest rates and whatever, and they're doing it a different way. Are these things the same thing? Are they all part of the same answer? Again, everyone's going to hate us, but just I'm going to assume anybody watching this owns gold, so they'll be happy. So then we can have a proper argument about it, discussion.
I'm just going to repeat myself. Theoretically, yes, and I would be willing to embrace it if I could hear one of the leading proponents actually convince me that they understood banking. Because the key to this is the provision of credit, and it still does have to go through the channel of banking or credit markets. I'm
not sure, Hugh. I'm not sure. I'm not sure that it can go direct. That's my point. Is as opposed to lending you money, I could just give you money.
But at the same time, however, you talk about, digital, Bobby Digital. There's one of the former members of the Wu-Tang, which is a infamous rap. I shouldn't be talking about Bobby Digital. It's a very rude song. But your Bobby Digital notion of wanting to play with that. Yeah, I just want to come back and say again, the Eurodollar market, the thing that just gets no analysis, and MMT doesn't look at it. No one looks at it, right? Because Luke will come back and say, well, the Chinese, they've seen you, they're smart, they're not going to buy your treasuries. If you go -3, the Chinese are leaving the building. And in fact, since 2016 or something, they haven't been buying the treasuries. And my response to that is actually the Eurodollar market has not been creating dollars to channel and push into the Chinese leg. It was doing so. It did that from 2000 to kind of 2012. And then it went, ooh.
Well, it's the Europeans and Japanese banks. That was the problem. They just clammed up and went, you're not having any of this.
So what I want to say is that there's a kind of dark web of credit creation, which is many multiples greater in size than actually the US government and US banking sector. And until we kind of actually shine a light on it, work out how they think and how we can have a dialogue with them, then you're still, I fear that you're still looking at half measures. I need to go 100% in.
So let's imagine we now live in a world of a central bank digital currency. So now, because it doesn't have to go through a bank, I can give it to you in St. Bart's and they can give it to me in the Cayman Islands. And so we don't need a Eurodollar market.
Wow.
So there's the world's reserve currency that actually can control the world's money supply.
I don't think we've got time left really to discuss the fractional reserve implications of digital versus the traditional banking model. There may well be a fractional reserve multiplication in that disintermediation that you described, but if there is, I don't know it as well as I should, perhaps.
It's just something to think about. Hugh, look, thank you as ever to pick your brains on this. I just thought it was really interesting because just to challenge the way people think. And again, you're not saying this is what I think, but this is a possible future. And the world is about possible futures where the answer is going to come from. Because I damn well know, you damn well know, that doing what we're doing now is not going to change anything.
Indeed. So and then, we have a trade. The Eurodollar is the essence of macro. Right? It doesn't cost you a lot. It has convexity. You said 200 times if we got some of these more outlandish predictions of mine. And so, like your parents were presenting the kids with little Christmas presents under the tree, and we're just saying to unwrap it. Well, let's see what the future brings. But if it brings anything remotely close to what we're talking about, boom, you're going to enjoy Christmas morning.
Absolutely. Hugh, as ever, my friend, great to speak to you, and I'll speak to you very soon.
Thank you very much, Raoul. Thank you. Thank you all.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.